So one of the things that always kind of bugs me is the discussion between 401k tax-deferred investing and taxable investing. And the default answer that you ask anybody is that you always want to do tax-deferred. And knowing a bit more about the tax treatment of these things, you start to wonder, is that really true? Because with a 401k, you put in money tax deferred, so it reduces your taxable income in the current year, but then when you withdraw it, you're taxed at ordinary income rates. And in a taxable account, you pay the income tax on whatever it is in the current year, and you're going to pay dividend taxes and any kind of capital gains if you have trading along the way, but at a lower rate. And then in the decumulation phase, your tax rates are not at ordinary income rates, they're at dividend rates or capital gains rates, which at least currently are lower than ordinary income rates. Now, as with all tax-related things, these things can change. Congress can decide that we're going to do away with the special dividend tax rates, or they could say, well, we're going to make dividend tax rate 0 just for everybody. Who knows? But at the current state of affairs, right now, dividends and capital gains are less than ordinary income rates. So how does that translate into a long period of accumulation, and then when you start withdrawing in some kind of retirement? So I ran the numbers. Couple things. Total expected return, I did it at 8.8%, which is the long-term compound annual growth rate of the stock market. Of the dividends, I assume 2% of that 8.8% was dividends, and that leaves 6.8% as capital gains. Marginal income tax rate, I just picked 28%, fairly high earning person or couple. Capital gains tax rate is 15, dividend tax rate is 15, which is currently, if you're in the 28% bracket, that would be your tax rates. And then safe withdrawal rate, I just assumed 4%. So how does a 401k compare to a taxable account? Well, what I did was I looked at the contribution limits for the 401k over the past 30 years, and I assumed that whoever was making this investment was contributing the maximum right here. So this is actually the history of the maximum contribution. And then I calculated the total returns, and then withdrawals, which would be none during the accumulation phase. Income tax on that withdrawal, again, would be none during the accumulation phase. And then the portfolio net value. So over 30 years, contributing the max, assuming you made 8.8%, you'd end up with $1.4 million, which is pretty decent. So what do you do with that $1.4 million? Well, you start taking some money out. And at that 4% withdrawal rate, year one would be $57,000. Marginal income taxes on this would be 16, which leaves you a net of 41. And then hopefully your portfolio continues to grow at 8.8%. You're only withdrawing 4, so you'll still have some growth, but a slower rate. But the number's bigger, so it works out. And basically, over the next 10 years, you start making a little bit more, a little bit more, a little bit more. By year 40, 10 years after the beginning of the decumulation phase, you're up to 63,000. And of course, inflation is is constant throughout all this. So this $63,000 is worth much less than what it would have been way back here in year one. But this is the world that we live in. So what happens in a taxable account? Well, the tax equivalent investment would be this amount minus whatever the income taxes on it would have been. So tax deferred would have been 7 in this case. The tax equivalent would have been 5,040. And you're going to make investment returns on that amount. Some of it is going to be dividends, and some is going to be capital. And you're not going to realize any capital gains until you start to hit the accumulation phase, much like you don't start with the withdrawal in the 401k until you hit here. So what happens? Well, because you're investing smaller amounts, the total amounts are less, and we only end up with just shy of $1 million here in the taxable account. However, when you start to withdraw, again under current tax law, the taxes are lower, so 15% as opposed to 28% in this example. So the net withdrawal is a bit less, so 41 compared to 33. But because of the lower tax rate, you get to keep more of it, and more of it gets to work for you. So, by the time we're into year 10 here, it's 63 versus 59. The gap is closing, and that will continue to shift over time. So, it's not quite as cut and dried as everybody makes it. Now, there are a couple things to keep in mind in this kind of analysis. One is that the tax laws change. Even under current tax law, this is oversimplified because this taxable income and ordinary income tax rates, it's graduated. So we don't know what the breakdowns will be in the future. We don't know what this person would have as far as other income sources, maybe Social Security. So, it may be that this entire amount is taxed at this rate, or it may not be. It just depends on what's going on in that person's situation. Similarly, with the dividend rate, you might not be paying 15%. You might be paying 0% if you're in a lower tax bracket, or you might be paying 20% if you're in a higher tax bracket. So all of these things just kind of depend. And so this is a simplified analysis, and you have to be aware of that. Another thing to keep in mind is that in a 401k, your money's locked up till you're 59 and a half. Otherwise, you're going to hit 10% penalties. And on a taxable account, that is not true. You can use this money whenever. Now, some people argue that that's actually pointing in favor of the 401k because basically you can't be trusted with your own money because the temptation to cash out and spend it is too great. So, that's more personal than finance, but you can make your own decisions there. So I just wanted to make this video to have a broader understanding of 401ks versus taxable accounts, and especially if you're in a higher income range, the limits on the 401ks as far as contribution limits is just not going to get you where you want to go. If you're happy on $57,000 a year, then fine. But if you're trying to make 150, then that's not going to work. And you need to be in some kind of taxable investment, whether it be stocks, bonds, real estate, private ventures, whatever. So anyway, hope that's a little bit helpful for you. And the link to the spreadsheet so you can view it is going to be down in the comments section. And you can hit me up, with your thoughts.